The Psychology of Investing.
Chapter 17. Systemic Thinking for Market Cycles.
Market mood is the shared emotional climate investors are operating in at a given moment. Even when the facts are the same, people can interpret them through optimism, caution, greed, or fear, and those reactions affect what they do with money. That matters because markets are not moved by information alone. They are moved by millions of decisions made by human beings responding to that information. When confidence spreads, people become more willing to buy and hold. When fear spreads, that same crowd can rush to sell. So if you want to understand market behavior more fully, it helps to pay attention not just to the numbers, but also to the emotional tone surrounding them. Facts and emotion play different roles in the market. Prices, earnings, and returns tell you what has happened or what is being reported. But market mood helps explain why people may be reacting so strongly to those facts.
Two investors can look at the same earnings report and come away with very different levels of confidence.
In a nervous market, a small disappointment can trigger heavy selling. In an excited market, modest good news can fuel a much larger rally than the underlying event seems to justify. That is why emotion can amplify market moves and sometimes matter almost as much as the event itself. One of the most important times to watch mood is when it becomes extreme. Deep pessimism often shows up late in a downturn, after people have already experienced a lot of pain and many have given up hope. Euphoria often appears when prices have been rising for a while and people begin to speak as if gains are almost automatic. At those moments, the crowd may already be leaning heavily in one direction, which can leave the market vulnerable to a turn. That does not mean an emotional extreme tells you the exact day a reversal will happen. It simply means extreme mood can be a clue that the market has stretched further than usual. A practical rule of thumb is this: when the crowd becomes emotionally extreme, do not speed up your decision-making. Slow it down. If everyone seems highly confident, that is often a reason to become a little more cautious, not more aggressive. If fear is everywhere, that may be a reason to look more carefully, not to assume disaster is certain. Mood is useful context, but it is not proof by itself. The goal is to notice emotion clearly without letting it take control of your choices. You do not need a complex model to start observing market mood. Begin with ordinary sources, headlines, conversations, market commentary, and the tone people use when they talk about investing. Then, compare that tone with what prices are actually doing, because sometimes the story sounds dramatic, while the market reaction is relatively calm. Pay attention when there is unusually broad agreement,
since crowds become most interesting when nearly everyone seems to share the same belief.
Also, include yourself in the observation process. If you feel a strong urge to buy quickly or sell quickly, that feeling may be giving you a small but useful clue about the emotional environment around you. Write these observations down, and over time, you will begin to see patterns more clearly. Elevated excitement often reveals itself before people realize they are caught up in it. Headlines begin to sound unusually certain, as if the path upward is obvious, and risks barely matter.
Conversations shift from careful analysis to confident assumptions that gains will simply continue.
Online discussion becomes louder, faster, and more one-sided, with people rewarding bold certainty more than thoughtful caution. You may also notice fear of missing out rising in yourself, especially when sitting still starts to feel more uncomfortable than taking risk. Excitement is not always wrong, but when optimism becomes intense and widespread, it is usually a good moment to pause and think more carefully. Panic often looks like the mirror image of excitement. After a sharp drop, headlines can turn dramatic very quickly, and people who were recently enthusiastic may suddenly want out at any price. The crowd shifts from confidence to fear, and that emotional swing creates intense pressure to act immediately. In those moments, lower prices can feel like proof that something must be terribly wrong, even when the situation needs calmer review. Sometimes the right response is to do nothing right away and recheck the fundamentals. Panic may signal real risk, but it can also reflect emotion, running ahead of careful judgment. A good way to build this skill is to practice noticing mood without making any trades based on it. Spend 5 minutes a day for a few days simply recording what the headlines sound like, how people are talking, and what emotions you notice in yourself. Ask whether the overall tone feels moderate or extreme, rather than whether the market will go up or down tomorrow. Include any urge to act, because that urge is often one of the clearest emotional signals. After a few days, review your notes and see whether the mood stayed steady, intensified, or reversed. This kind of observation habit trains awareness without forcing you into premature decisions. Market mood is helpful, but only if you use it with discipline. One common mistake is assuming your personal feelings represent the entire market, when they may only reflect your own stress or excitement. Another is overreacting to a single headline or one dramatic day, even though sentiment usually becomes meaningful through pattern and persistence. Mood also should not be treated as a complete investment strategy on its own. At the same time, it is a mistake to ignore fear or greed in yourself, because your own emotions are part of the decision environment. Sentiment can offer clues, but it will never give certainty, and expecting certainty from it usually leads to poor judgment. Once you understand that markets carry an emotional tone, it becomes easier to see why sentiment indicators exist. These tools try to measure the background mood investors are operating in, not just the fundamentals they are reacting to. Fear, optimism, and uncertainty influence buying and selling pressure, which means they can shape prices in important ways. Sentiment indicators give you a way to observe that emotional backdrop more systematically. They do not replace valuation, earnings, or economic analysis, but they can add useful context. In other words, they help you understand how people feel about the facts, not just the facts themselves. Two widely watched sentiment indicators are the put-call ratio and the VIX. The put-call ratio looks at options activity and can give you a sense of whether investors are leaning more toward protection and caution or toward bullish positioning. A high put-call ratio often suggests fear or defensiveness, while a low ratio can suggest confidence or even complacency. The VIX measures expected market volatility, so it tends to rise when investors become more uncertain or nervous about future price swings. These indicators are different, but both provide a window into crowd behavior. They are useful not because they tell the future directly, but because they help describe the emotional environment investors are navigating. Sentiment becomes especially interesting when it reaches unusual extremes. Ordinary readings often do not tell you much, because everyday fluctuations in mood are normal and often not very informative. But when fear becomes intense, it can hint that selling is getting crowded and may eventually exhaust itself. When enthusiasm becomes extreme, it can suggest the market is more vulnerable because so much optimism is already reflected in positioning and expectations. This is where contrarian thinking begins. A contrarian is not simply doing the opposite of everyone else all the time. A contrarian is paying close attention when the crowd becomes unusually one-sided. It is important to handle contrarian signals carefully. An extreme reading is a clue that conditions may be stretched, but it is not a guarantee that the market will reverse immediately. Fear can stay elevated longer than expected, and optimism can remain intense while prices continue rising. That is why sentiment should not be treated like a crystal ball. Its main value is in telling you that a market condition deserves closer study, not that you have found the exact top or bottom. Patience still matters, and so does confirmation from the market itself. To read sentiment well, you need context. A single number means very little unless you compare it with its own recent history and typical range. For example, a put-call ratio of 0.9 may not sound dramatic by itself, but it becomes more meaningful if the recent average has been much lower. The real question is whether the current reading is unusual relative to what has been normal lately. That helps you separate meaningful extremes from everyday noise. In practice, sentiment is most useful when you focus on rare conditions rather than reacting to every small change. Even a strong sentiment extreme should be tested against price behavior. If fear is extreme, but prices keep making sharp new lows, the case for an immediate turning point is weaker. If fear is extreme and the market starts to stabilize, stop falling, or recover modestly, that makes the signal more interesting. Price action helps tell you whether emotion is beginning to burn out or is still intensifying. It also helps to place the signal in a broader trend and economic context. Sentiment alone can warn you that something important may be happening, but confirmation helps you judge whether the market is actually starting to respond. A disciplined contrarian approach is less about boldness and more about planning. Because uncertainty is always high at emotional extremes, you want to decide in advance how you would act, rather than improvising in the moment. That might mean scaling in gradually, instead of taking one large position all at once. It also means setting risk limits and being honest about what would prove your idea wrong. If the thesis breaks, discipline requires you to respect that, not argue with the market indefinitely. Sentiment can provide the clue, but risk management is what turns that clue into a responsible decision process. Consider a simple example of extreme fear. Imagine the S&P 500 has fallen about 25% from its high. Recession worries dominate the news, and the put-call ratio jumps to 1.1 compared with a more typical 0.7. That combination suggests pessimism may be getting crowded. Investors are demanding more downside protection. Headlines are negative, and many expectations may already be leaning toward more trouble. A contrarian would notice that setup, because one-sided fear can eventually become less informative once everyone is already braced for bad news. But even here, the correct conclusion is not buy immediately. The better conclusion is that conditions may deserve closer attention and a more structured plan. In that example, the investor responds gradually rather than trying to nail the bottom. They might buy a quarter of the intended position now, add another quarter if the market falls 5% more, and then wait for evidence of stabilization before committing the rest. That approach acknowledges that fear may be extreme, while also respecting the possibility that prices could still go lower. As the market stops making new lows and sentiment begins to cool, the contrarian signal becomes less dramatic, but more actionable. In other words, the strongest emotional reading often appears before the clearest price confirmation. A staged plan helps bridge that uncertainty without forcing an all-or-nothing decision. Most mistakes with sentiment come from treating it like a standalone trading trigger. One error is acting on the first extreme reading, as if the market must reverse right away. Another is ignoring the broader trend, even though strong trends can continue longer than sentiment alone might suggest. Investors also get into trouble when they rely on a single indicator instead of combining sentiment with price, trend, or valuation evidence. And perhaps the biggest mistake is skipping risk management entirely because the signal feels compelling. Sentiment works best as a supporting tool, not as a substitute for a full decision process. The key takeaway is simple. Sentiment indicators help you measure the market's emotional tone. Their value becomes greatest when fear or optimism reaches unusual extremes, because that is when crowd behavior can become one-sided and potentially unstable. Even then, sentiment works best when it is confirmed by price action, trend behavior, and other evidence. It can tell you when conditions are worth closer attention, but it cannot remove uncertainty. So use sentiment to understand mood, focus most closely on extremes, and keep risk discipline at the center of any action you take. Sentiment does not just influence short-term moves, it helps shape full market cycles. Prices rarely move in a straight line because investor confidence and fear rise and fall in waves. As confidence builds, it can reinforce an uptrend by attracting more buyers, which pushes prices even higher. As fear spreads, it can deepen a decline by causing more selling, which puts further pressure on prices. In that way, emotions often magnify underlying business and economic realities rather than merely reacting to them. Understanding cycles means understanding both the facts and the emotional feedback loops that grow around them. One helpful mental model is to imagine a crowd moving through a tunnel. If the tunnel feels bright and safe, people move forward faster and with more confidence, even if the tunnel itself has not changed very much. If the tunnel feels dark or threatening, the same crowd hesitates or rushes backward, again reacting more to perception than to structure. Markets often behave the same way. The underlying environment may change slowly, but perception can change quickly, and shared perception drives crowd behavior. That is why sentiment shifts can produce large market swings, even when the facts evolve more gradually. Although every cycle has unique details, the emotional sequence tends to repeat. It usually begins with optimism, when a few investors start buying after a difficult period. As prices rise, excitement spreads, and confidence becomes more widely shared. Near the top, euphoria can take over, making risk feel small and gains feel easy. When the market weakens, denial often appears, with investors expecting only a temporary setback. If losses continue, denial gives way to fear and eventually despair, which is often where the emotional reset for a new cycle begins. This emotional sequence helps explain why investors so often buy high and sell low. Prices feel safest after they have already risen, because the recent past makes continued gains seem normal and likely. That sense of safety draws in late buyers near peaks, often when risk is actually higher than it looks. On the other side, prices feel most dangerous after large losses, which pushes investors to sell when fear is greatest and valuations may be more attractive. Strong feelings often show up at the worst moments for good decision-making. Stepping back from the crowd is difficult, but it is one of the most valuable habits an investor can build. Market mood usually changes in stages rather than all at once. After a hard period, stability starts to return and a few early buyers begin to reappear. As prices rise, attention grows and confidence spreads, pulling more participants into the move. Eventually, caution fades, a peak forms, and enthusiasm remains strong, even as the market becomes more fragile. Then the decline begins, but denial often delays action because many investors expect a quick rebound. Fear deepens later, and only after selling pressure burns out does the emotional foundation for recovery start to rebuild. A fictional company can make this pattern easier to see. Imagine GreenEdge, a solar panel company, trading at $10 to $12 after a long, rough period. Very few investors are interested then, even though that may be when the value case is strongest. As the stock rises to 20, then 35, enthusiasm grows and turns into fear of missing out.
When it slips back to 28, many investors dismiss the decline as temporary because the optimistic story still feels intact. But if the shares keep falling towards 6, excitement can flip into fear and then despair, even though it is still the same company the whole time. One subtle point about cycles is that news often follows the mood shift rather than pausing it entirely. Sentiment and price can start weakening before a headline appears that seems to explain the move. Then a relatively small setback becomes the story everyone points to, even though the emotional turn was already underway. In that sense, news often reinforces a feeling that was already building in the market. This is why a modest event can sometimes trigger a surprisingly large reaction. The story may feel like the cause, but often it is also serving as an explanation after sentiment has already begun to change. Reading cycles in real time is hard, and a few common mistakes make it harder. Investors often confuse quiet optimism early in a recovery with the far more dangerous excitement that appears later. They may assume news alone caused the cycle, when in reality sentiment and positioning were already shifting. Another frequent error is believing that this time is completely different, which can blind people to recurring emotional patterns. Denial is also easy to miss, even though it is one of the most important transition stages between confidence and fear. And many investors forget that despair, uncomfortable as it feels, can be the emotional condition that precedes recovery. A practical way to learn cycle psychology is to apply it to your own history. Think back to a past purchase or investment decision and write down what you were feeling at the time. Were you confident, urgent, fearful, or relieved? Then ask which stage of the cycle best fits that emotional moment. Finally, consider whether waiting would have changed the choice or improved the decision. The goal is not to criticize yourself. It is to see more clearly how emotion may have influenced timing. Understanding cycles is useful, but it becomes much more powerful when you connect it to action. Different market phases create different combinations of trend, sentiment, and risk, so it makes little sense to respond the same way in every environment. A phase-based plan helps you decide ahead of time what you intend to do when conditions change. That reduces the chance that fear or excitement will take over in the moment. It also reminds you that a strategy suited to one phase may be unhelpful or even harmful in another. Planning by phase is really a way of turning observation into discipline. A simple framework breaks the market into 4 main phases: accumulation, markup, distribution, and markdown. Accumulation usually appears after weakness. When prices are still subdued, mood is pessimistic, and gradual buyers begin stepping in. Markup is the sustained rising phase, where confidence returns and momentum builds. Distribution tends to happen at high prices, when enthusiasm remains strong, but gains begin to slow and risk quietly increases. Markdown is the falling phase, where fear rises and selling pressure builds. These labels are not perfect, but they give you a useful structure for matching behavior to conditions. The first step in using that framework is identifying the current phase with observable evidence. Start by asking whether prices are generally rising, falling, or moving sideways over a meaningful period, not just over a day or two. Then look for patterns such as higher highs and higher lows, or lower lows and continued weakness. Add a sentiment layer by noticing whether the mood feels fearful, merely confident, or genuinely euphoric. Price behavior and mood together often tell you more than either one alone. And it is worth remembering that no single signal will be perfect, so phase identification is about clues and probabilities, not certainty. Once you have a framework, define one clear action for each phase. In accumulation, that might mean investing regularly through dollar-cost averaging, rather than waiting for perfect clarity. In markup, the action may be to hold steady and only rebalance if the portfolio becomes too risky. In distribution, a sensible response could be trimming gains gradually instead of trying to guess the exact top. In markdown, the key action may be to avoid panic selling and follow preset defensive rules. Specific actions are easier to follow under stress than vague intentions, which is why clarity matters so much here. A phase plan becomes much more useful when you add transition rules. These rules should be broad enough to avoid noise, measurable enough to follow, and simple enough to remember. For example, you might decide that a large decline from a recent peak shifts you from a more bullish stance to a more defensive one. The point is not to react to every headline or every volatile day. The point is to reduce hesitation and second guessing by deciding in advance what kind of change is meaningful. Good transition rules create consistency without pretending to deliver precision. Discipline also means reviewing your plan regularly rather than constantly. Long-term investors often gain little from non-stop monitoring, because frequent checking tends to magnify noise and emotional pressure. A quarterly review is often enough to reassess the market phase, confirm your actions still fit your goals, and see whether your transition rules have truly been met. If conditions are mostly unchanged, staying with the plan is often the best decision. If a real phase shift has occurred, then you can respond deliberately. Regular review keeps you engaged, but not captive, to every market twitch. Consider Rosa, who uses a written phase-based plan instead of trying to predict exact turning points. During accumulation, she invests $2,500 each month for 4 months, accepting that the exact bottom is unknowable. In markup, she keeps holding and avoids the temptation to chase higher prices emotionally. In distribution, she sells 20% to lock in part of her gains and reduce risk gradually. In markdown, she does not panic sell. She waits for clearer stabilization and follows her written rules. Her advantage is not superior forecasting. Her advantage is that she already knows how she intends to respond. What made Rosa's plan effective was discipline, rather than prediction. She accepted uncertainty instead of freezing until the exact bottom became obvious, which it never does in real time. She also resisted the urge to add aggressively during emotional rallies, when excitement can distort judgment. When risk increased, she reduced exposure step by step, rather than exiting all at once and turning the process into another emotional swing. Most importantly, she followed written rules when fear rose, which is exactly when many investors abandon their plans. The result came from a steady process, not from calling the market perfectly. You can build your own phase plan in a very practical way. Write one action for each of the 4 phases and make sure each action is specific enough that you can actually follow it under stress. Add a brief reason for each action so you remember the logic behind it when emotions rise. Then choose a simple percentage-based or trend-based rule that helps you recognize when to shift from one phase response to another. Finally, check that the whole plan fits your real goals, time horizon, and comfort with risk. A good plan is not impressive on paper, it is usable in real life. Most planning mistakes come from inconsistency or overly emotional adjustments. Some investors use the same strategy in every phase, even when conditions have clearly changed. Others rely on hope instead of a written plan, and then discover, in stressful moments, that hope provides no guidance at all. Triggers can also be designed too tightly, which creates frequent trading and unnecessary noise. Another common problem
is overriding the plan because of headlines or temporary emotion. And whenever life circumstances change, ignoring risk management can turn an otherwise sensible plan into an outdated one. The main lesson is that a phase-based plan will not make your timing perfect, but it can make your decisions far more consistent. By deciding your actions before emotions take over, you reduce the odds of chasing highs or panicking at lows. Matching your response to accumulation, markup, distribution, and markdown creates a more flexible and realistic investing process. Simple transition rules help you adjust without overreacting. In the end, the value of the plan is not prediction. It is giving discipline a better chance than fear or greed. Even with a good plan, uncertainty can still disrupt good decisions. When outcomes feel unclear, the mind naturally wants certainty, control, and fast answers, because uncertainty triggers urgency. That response is deeply human, but in markets it can push people toward rushed decisions that feel relieving in the moment, rather than wise in the long run. Stress narrows attention and makes action feel safer than waiting, even when waiting would be more useful. Fast action is not always bad, but it is often overrated in investing. Rational decision-making begins with recognizing that uncertainty itself changes how your mind behaves. Under stress, investors often give too much meaning to incomplete information. A rumor can start to feel like proof simply because it arrives in an emotionally charged moment. A one-day drop can seem catastrophic, even when it is only a small part of a much longer trend. A sharp rally can look guaranteed to continue, even though short bursts upward often reverse. Stress also makes short-term noise feel like genuine signal, because the mind wants a clear story quickly. This distortion is one reason uncertain markets can produce such unreliable thinking, even in smart, experienced people. Two emotional traps show up again and again when uncertainty is high. The first is panic selling, where fear of further losses creates a powerful urge to get out immediately. The second is FOMO buying, where fear of missing gains creates the opposite urge to jump in quickly. These reactions feel very different, but they come from the same source: urgency. In both cases, emotion starts to override the long-term plan. Recognizing that shared pattern makes it easier to pause and ask whether you are responding to strategy or to pressure. Staying rational does not mean becoming emotionless or predicting the future perfectly. It means building a guardrail between what you feel and what you do. That guardrail can be as simple as pausing, separating feelings from facts, and returning to rules you created while calm. Process matters because it gives your mind structure when uncertainty is trying to collapse everything into a single urgent moment. Good guardrails do not remove risk or fog from the market. They simply reduce the odds that stress will push you into a decision you later regret. The first two steps are simple but powerful. Name the feeling and name the trigger. If you feel fear, greed, anxiety, or excitement, label it plainly instead of letting it remain a vague pressure in the background. Then, write down the specific fact that triggered the emotion, such as a 6% drop, a headline, or something someone said. Keep that trigger factual and brief. Do not add interpretation yet, because interpretation is where emotion often begins to tell stories. This small pause helps separate what happened from what your mind is starting to imagine. After that, use two questions to slow the trade. First, ask, would I still do this after 24 hours? Second, ask, does this decision match my calm plan? If either answer is no, wait at least one day before acting. That waiting period is not weakness. It is a filter for emotional urgency. If your answer changes dramatically after a day, That is often evidence that emotion was driving the original impulse more than durable judgment was. If the urge still remains, replace drama with context. Review longer-term price history so you can see whether the current move is truly unusual or just part of a broader pattern. Check the fundamentals of the company or fund to see whether the investment case has actually changed. Read a neutral, credible summary rather than consuming only dramatic commentary. Then return to your checklist and ask whether the trade still fits your goal, risk tolerance, and timing. This sequence helps move you from emotional reaction to informed decision. Imagine Rachel sees a frightening headline and notices her retirement fund is down 6% for the week. Her first feeling is fear, and instead of acting immediately, she names it. She writes down the trigger clearly, the headline and the weekly drop. Then she asks the two slowing questions, and both answers are no, because her long-term goal has not changed, and the urge is coming from stress, not from a revised plan. When she reviews the context, she remembers she has a 15-year horizon and a diversified retirement fund. That calmer perspective helps her avoid turning a temporary emotional shock into a permanent selling mistake. During uncertain markets, people often fail not because they lack intelligence, but because stress pushes them into weak habits. Many rely on willpower alone, even though stress usually overwhelms intention unless a process is already in place. Others treat headlines like facts, forgetting that news is often noisy, partial, and emotionally framed. Some try to create an entirely new plan in the middle of a crisis, which is usually the worst time to design one. Investors also confuse short-term volatility with long-term change and end up trading too often under pressure. The cure for these mistakes is not toughness alone, it is preparation. A personal rationality checklist can be one of the most practical tools you build. It might begin with 5 questions. What am I feeling? What single fact triggered it? Would I still act after 24 hours? Does this fit my long-term plan? And what calm information should I review first? The point is not to eliminate emotion. The point is to keep emotion from becoming the sole author of your decisions. If you create this checklist while calm, it can serve as a trusted guide when markets feel chaotic. In uncertain moments, a prepared process is often more valuable than a clever opinion.